Welcome to Centennial Advisors. We use our cutting-edge technology and collaborative client-focused brokerage team to provide the highest level of professional service at all stages of our clients' investments. Our team has decades of experience in all types of markets, guiding clients through some of the most challenging times for investors. Our all-hands-on-deck approach generates more offers on your listing, and according to CoStar, we have sold our listings faster and with the highest list-to-close percentages over the past 2 years. For buyers, we identify and negotiate the best terms possible, ensuring your long-term success. We hope your time with us today helps your passive investments become massive investments. Centennial Advisors, here for you now and always.
Good afternoon, everyone. It's May 26, 2022, and I'm Justin White, Managing Partner of Centennial Advisors. I'm joined today by Jason Brooks of Buckhalter. And it's our pleasure today to talk to you a little bit about opportunity zones. Jason and I have done this webinar, one similar to it, a number of times over the last year, and keep coming back to it is really what we think is one of the most valuable opportunities available today for people who enjoy real estate investing. What we're going to talk about is the opportunity zone, what it is, how you can make money in it, in a unique, what we call the opportunity zone secret, in a little utilized to this point, opportunity within opportunity zones that is highly profitable and a great tax shelter. In a nutshell, opportunity zones are a tax strategy with a real estate benefit, and Jason and I will walk you through a number of different components of it over the course of the next hour, and we'll open it up to questions at the end. Thanks again for joining us, and this should be a fun afternoon. To start, we're going to talk about just what is an opportunity zone. Jason, you want to let everybody know kind of what the key components are as Camille gets our slides up and everybody can view some of the key points you'll be talking about.
Sure, absolutely. So really quick, Andrew asked if it's going to be recorded. Yes, I think it'll actually be recorded and then published on the Centennial YouTube channel, if that is correct, Justin?
That is correct.
So opportunity zones are zones designated, or area census districts designated by Congress, where Congress essentially wanted to stimulate additional economic investment by creating benefits for the investors. And, you know, what we talk about all the time is there are many of these areas that really did need investment stimulation. And then there's the ones that we try to find and target as well that were let's just say accidentally included, or we think that we're not necessarily ones that needed the opportunity. They're in great locations, and the upside is even better, and it's a safer investment as well.
So in addition to that, opportunity zones came about in 2017 as one of the very few, let's call it bipartisan supported initiatives during the Trump presidency. In fact, such a popular thing amongst both sides of the aisle that there's some revisions in progress now to continue the program, and we'll talk about those in a little bit as we work our way through the presentation today. The next question that people usually have is, how does an opportunity zone work?
So an opportunity zone, we'll talk about the different steps as you go. So first, you have to have a capital event where you realize a capital gain. To then invest into an opportunity zone, you need to invest only the capital gains. So in a traditional 1031 exchange, you would invest not only your initial basis, but your gains as well. In this situation, you actually get to keep your basis and only invest the capital gains. And those capital gains can come from the sale of a business, sale of a publicly traded equity like Apple stock, or the sale of real estate. You invest those capital gains funds into a qualified opportunity fund. Now, you can either have your own qualified opportunity fund, which is one of the things we really like to do with clients, or you can invest in a much larger fund where a much larger developer is building, a very substantial project in size, scope, and scale. And then once you invest, you get to pay your capital gains taxes, at least federally, and maybe statewide, depending on where you live, on your 2026 tax return, so April of 2027. So that's the first benefit. The second benefit is if you hold the property for 10 years, you don't pay any tax on the appreciation and the gain. Therefore, you could actually depreciate the value of the property down to zero with no depreciation recapture, as well as increase the value of the property without paying tax on that as well. The only thing you would pay tax on during that time is the cash flow off of the property.
Fantastic. And as you can see on the slide, most things you can invest in. And what you really got to try to do, or what the objective of it is to invest money into a business or a property that creates jobs and improves an area. So you can see a golf course or a hot tub facility, really popular business these days. Racetrack, cannabis, some of these sort of things fall into opportunity zone investments or businesses that don't qualify. But we'll go to the next slide, and Jason, you can talk in a little more detail, or maybe cover those points again. Is what are the incentives that you get in an opportunity zone, or by investing in an opportunity zone?
Right. So the first is you get to defer the payment of your capital gains tax. Now, federally, you get to defer that until April of 2027 on your 2026 tax returns. If your state recognizes capital gains, then you get to also defer your state payment. Unfortunately, California doesn't recognize that, so your California payment would need to be made the following year. Additionally, you get what we refer to as tax-free appreciation. So every dollar that goes that the property increases in value over your hold period, so long as you hold it for 10 years and sell it before 2046, is tax-free. So instead of paying anywhere between 33 and 50% tax on it, it's tax-free. Additionally, for people that invested prior to the end of 2021, you got a 10% reduction in the overall tax bill. There has been some discussion about potentially extending this benefit as well. We are not certain if it will happen yet, but it has been discussed that will be tagged along with the actual extension of the Opportunity Zone program.
I think one of the things that's been interesting is Jason and I have worked with a number of clients is they keep kind of coming back to the one point on the tax deferral is it's basically like getting a 4 or 5 year interest only loan from the government, where you can take the money that you would owe in taxes, get that to work on your behalf, make some money on that money, and then you have to pay the tax with no interest over the now 4 or 5 years that you would be able to use that money.
Well, and Justin, the nice thing to go along with what you just said is if the inflation number continues where it's at, if you get to pay with dollars that are 5 years from now at an 8% compounding inflation, it's going to be the dollar's going to be worth roughly 50% of what it's worth today. So you're paying, essentially a substantially lower tax bill. I did forget to mention that there is no depreciation recapture as well. So you're actually incentivized to accelerate the depreciation on the property to create additional tax losses for your tax returns to offset additional gain. So it's not a real personal loss. It's just a tax loss that will offset personal gains or other personal income.
Or other real estate investment income.
Correct.
All right, let's talk a little bit about the difference between opportunity zones and 1031 exchanges.
Sure.
Actually, maybe we'll talk on this one briefly, is what type of projects qualify. So there's a couple things that you have to do when for the property to qualify as an opportunity zone eligible piece of real estate. It must be acquired by purchase, so you have to go out but you can't own the property already or before 2017 and it work for you. You could buy the opportunity zone property next door to your building that's in an opportunity zone, but you can't retain ownership of a property that is now in an opportunity zone before it was in the opportunity zone was defined. The second thing is that the original use of the property has to start during your ownership of the building. So you can't acquire a already built, let's call it 20 unit apartment building that's been there for 30 years and get the opportunity zone benefits because you're not making any substantial investment into the area. So properties that are under construction, land that it could be developed were the early, targets of opportunity zone funds. over the last few years, we've been able to uncover some of the nuance of the opportunity zone legislation and found more opportunities for people that weren't builders or prefer to be as passive investors as they can be. Jason, you want to talk a little bit about the 1031 and opportunity zones and kind of how they differ or compare?
Sure, absolutely. And to touch on one thing you said too, Justin, you could, in theory, buy a 20-unit apartment building, but you'd have to invest such a substantial sum of money. It would require not only renovating all the units, but likely building another 6, 7, 8, 9 units. If you could find something that worked, we could probably make it work, but it has to do with and I think we'll eventually get there, how the finances work within the deal. And so the differences between 1031, right? So a 1031 exchange is a tax deferred exchange. Everybody keeps saying I don't have to pay tax. Well, no, you're just deferring your tax down the road, right? So one of the downsides is you have to 1031 your initial basis of dollars, any profit you made, and then replace the debt that you've done as well. The nice thing about the opportunity zone investments is you actually get to pull your principal, your initial investment minus any depreciation back and put it in your pocket today, tax-free. You don't have to worry about any debt replacement. And all you have to do and worry about is investing your capital gains into an opportunity zone investment deal. Now, the only downside of the opportunity zone deal is you have to hold the property for a minimum of 10 years. But in theory, most people, when they think about 1031 exchanges, are just going to continually exchange for the rest of life. So 10 years is actually much shorter than in perpetuity over time. And so the last nice part of it really, besides no depreciation recapture, which is a bit additional tax benefit, is when you actually go to sell the opportunity zone property, there is no tax on any gain that you make. Whereas if you were to sell a 1031 property and not want to 1031 it again, you would ultimately pay the tax.
You also want to talk a little bit about the timing of the two or how they compare?
Sure. So when you on a 1031 exchange, it's pretty straightforward. You close your deal, the money goes to the 1031 accommodator. From the day of close, you have 45 days to identify what we refer to as the up-leg property that you're going to buy. Then, inclusive of that 45-day period, a 180-day total period to close on the purchase of that property. With an opportunity zone, you have 6 months from the realization of your capital event, which we'll talk about in a second, to invest into an opportunity fund. And then the fund has 6 months to buy a property. Well, you might ask, what's the realization of your capital event? Is it the day I sell? Is it the day that, the money gets to my bank account? It actually depends. The IRS has a few definitions. And for some people, like you could sell an asset today, but not get your K1 until next year based on a December 31st year end from a tax perspective, and your actual realization would be December 31st. So there is actually a way where you can have substantially more than 6 months to decide to put the money into a fund.
Great. I'm going to ask you a question we've got from the chat right now. If we invest Mehdi asks, if we invest the capital gain portion in an opportunity zone now and keep it for 10 years, the question is no state or federal taxes. Clarify
Correct.
That again about deferral of your current gain and let's call it avoidance of your future gain.
Got it. So with your current gain that you're investing, you will ultimately pay tax. Whether in California, you would pay that the following year. And we can talk about how the accelerated depreciation might offset that California bill substantially. And then the federal bill will have to be paid as of today in April of 2027. If they do extend the opportunity zone period, they're talking about extending the payment date. That would potentially an additional 2 years. So it'd be April of 2029 if they do extend it. And so that gain has to be paid. When I'm saying that there is no capital gain or no tax paid, that's on the sale of the asset that you buy with your opportunity fund, right? So if Justin and I each have $500,000 in gain, we buy a property for $1 million, we hold it for 10 years, and we sell it and it's worth $2 million, we don't pay any gain on the $1 million increase. Additionally, if we depreciate that initial $1 million down to $500,000, normally we'd have to pay tax on the $500,000 of depreciation and the $1 million. We won't pay tax on that $500,000 of depreciation either.
So, yeah, and I think Jason just went through the numbers. it's good to just maybe talk a little bit about where we're seeing investors come from with their capital gain, because, as you do a lot of real estate work, we're in the real estate business. We do tons of 1031 exchanges and help people buy and sell property all the time. But this isn't really somebody selling their real estate, although it does make sense in certain circumstances to do an opportunity zone versus an exchange. This is investors that have capital gains that are coming from other things, and they're using the opportunity zone tax strategy to also get some real estate and become real estate investors or put more money into real estate. You want to talk for a second about where we're seeing a lot of this capital come from?
Yeah, so absolutely. So a majority of the clients that we have worked with on these deals, both, Centennial and myself, are people that have sold a business recently, right? Or were investors in a limited partnership, right? So it's either people that were, had a business, they held it for 20 years, they decided to sell it, they have this gain and they'd like to defer their taxes. Also, oftentimes when you've sold a business, you get a big sum of money, but then you don't have any cash flow anymore. Right. And so this is creating, additional monthly cash flow for them, where they're going to get, cash in their bank like they would have like their paychecks or, their distributions monthly. Now they get cash flow. So most of these people have come from the sale of the business. On the real estate side, where we are seeing these investments actually is people that were investors into real estate deals as limited partnerships. The limited partnership made a substantial amount of money over the last few years. They sold. They obviously, because of the way the partnership structure was set up, could not 1031 exchange. So they distributed all the capital gains to the partners. The partners were like, I don't want to pay tax. I'm used to exchanging, but I don't have that option now. What can I do? Well, they put their money into their own opportunity zone deal and they buy another one. One of our clients that, we've been working with, he had a couple of those situations where he invested in apartment buildings that did well. And then he also made a bunch of money on the sale of his home. And he took that capital gain off the sale of his home and he invested it right into an opportunity zone. And he now is, buying 3 or 4 assets within his, opportunity fund. And he talks all the time about the depreciation benefits alone over the cash flow and owning the real estate. So.
Yeah, it's been interesting to work with a couple different people in these things, especially people that have a business that are maybe getting older, and there's no place for the business to be given or go to. And, in some cases, sometimes people shut these business down and now they have like no cash flow. And we worked with a couple people that have been able to exit the sale of their business and then take that equity from the business that may have disappeared had they not had a liquidity event, and put it into a piece of real estate that ultimately they're going to get the cash flow from, and they're potentially going to be able to leave the real estate and the equity to their heirs to use for future generations. Paul's got a question for us. Can a recently acquired property in an opportunity zone through 1031 exchange be qualified as an opportunity zone investment with new construction in the next few years? Jason, I'm going to let you answer the question, and then I'm going to tell Paul his actually the positive option that we have for him, because I want to look good and I want you to tell him maybe the kind of bad news.
All right. So Paul, I know where you're going with this. Paul, the answer is no. Unfortunately, you have to acquire the property with an opportunity fund. So no, it would not qualify, but Justin's going to tell you why you have a great deal in front of you.
So Paul, even though it doesn't qualify for you right now, because of kind of our knowledge and what we've been able to do with this, as you start to develop that project, you're probably going to want to meet with us, because there is an opportunity for you to profit from the opportunity zone, and the fact that you are prepared to build it and put new construction on it. And so let's talk down the road as you get closer, because you have an opportunity that few people are taking advantage of, because they don't realize how they can get a premium for exactly what you've got. We do realize how you can get a premium, and we've been excited to help some people realize it. And then once we help you get that premium for this property that you have that you acquired at a 1031, maybe it makes sense to pay the capital gain and redeploy the money into opportunity zone for you to do again and build another deal. But we can walk you through that whole process as we get a little closer. It'll be fun to show you. but you have a phenomenal opportunity there to get a premium for the property that you did acquire.
Yeah.
Maddie's got another one. Go ahead.
I completely agree with that. The other one thing, Jay, that I was going to say is we talked about the people that are investing. The one place I think people aren't taking advantage of this is people that have owned real estate for a long time. They have no basis left in a deal, right? Their basis is extremely low. And 1031 is their only option in the future. Taxes historically have not gone down, and I don't think they're going to get any lower. And if they do eliminate the 1031, the opportunity zone is a complete hedge to the elimination of 1031, right? So we do have some clients that are starting to talk about a portion of their portfolio. Do I sell it, do an opportunity zone investment now, right? And set up the opportunity fund in my estate, because the estate actually inherits the benefits of the opportunity fund if they were to pass. And so they're essentially giving their kids a free additional step up in basis where they can hold the property beyond the death without any step up in basis issues, because it's the trust receiving the benefit. So that's an opportunity I think some people are still missing out on.
I think a lot of this stuff with opportunity zones is the more that we dig into it, the more that we look at different options, we uncover things exactly like you described. Because a year ago, that one wasn't on our radar of an additional benefit and way that people could use the opportunity zones to ultimately put a lot more money in their family's pocket. So I think that's a great point. Medi's got how do you claim the income on your tax return after it's sold?
That's something you want to chat with your CPA, and we're happy to introduce you to some qualified CPAs. I am not an accountant and I don't give tax advice. But my understanding is that it's just going to be treated as like you'll put it on as a dollar for dollar income and a dollar for dollar loss or offset. In reality, it's going to be on a K1 from a fund. So I think the fund's just going to say that there was no profit made on the K1. But we'll get that advice from an accountant.
All right, let's talk a little bit more about some of the thing. You want to go to the next slide so I can see exactly where we're supposed to be. Talk a little bit about meeting the improvement requirement in an opportunity zone. We touched on it briefly. You can't buy something that's been there forever. You gotta significantly improve the piece of real estate that you buy. Talk a little bit about that.
So the initial setup of an opportunity fund or opportunity zone transaction was that you would buy a property. I'm going to use $1 million for round numbers, but you buy a property for $1 million. The assessed value of the improvements is $500,000. There's a few different ways that they argue you can talk about assessed value. And then the land has a value. So you need to buy the property with capital gains funds plus debt, and then improve the property with capital gains money equal to the amount of the current assessed value of the improvements on the property. So I buy a property for $1 million. The structure on the property is valued at $500,000. I need to buy with $1 million of debt plus capital gains money. And then I need to improve the property equal to a minimum of $500,000 with capital gains funds. Now, there is a loophole in this that the IRS is allowing people to do, where Justin said something earlier that's very, very important. You have to be the owner of the property when it is put into its initial use. Now, initial use is generally defined as C of O or placed into service. So if you buy a property, pre-certificate of occupancy, new construction, the IRS is allowing you to take credit for the improvements done by the developer without having to do the work yourself. So we have done a half a dozen or a dozen deals now in the last 4 or 5 months where we are buying new construction, pre-certificate of occupancy, 2, 3, 4 weeks closed before the tenant occupies the property opportunities. And our clients love it because they get all the benefits without doing any of the work.
Talk a little bit about how long somebody has to make improvements if they are going to go buy a raw piece of land and they're going to go build something themselves, like Paul's going to do. How long do they have to get that done?
So generally speaking, you have 30 months. There are a few ways around this and a few loopholes. So if you do get some tolling on that 30 months, if certain regulatory issues, permitting, city take longer, there's ways to get extra time. The other option, there's a couple of big opportunities on developments where they're building high rises and it's going to take 4 or 5 years to build it. So they actually classified their opportunity zone transaction as an opportunity zone business. The business is the business of building, developing, and operating the building. And so an opportunity zone business has ongoing investment and it has ongoing amounts of time to put the money to work. But generally speaking, for the transactions we are looking at, you have roughly 30 months, give or take, but we can get you a little bit of extra time.
Jason, Mehdi asked a good question, and I think it's a good time to kind of address it, because what his question is so to qualify for the opportunity zone, you must sell the asset by 2046 and pay the taxes on original capital gain minus the depreciation, about a third of that amount, versus in exchange, you can keep deferring it forever. Mehdi, what I would say is that what we're saying here today is not that you should do an opportunity zone instead of a 1031 exchange. In certain circumstances, based on somebody's basis and their situation, it can make sense. And as Jason said, if you have concerns that they might eliminate 1031 exchange or stepped up basis, an opportunity zone might be a smart transition from using 1031 exchanges. But for the most part, what we're talking about today is not doing an opportunity zone instead of a 1031 exchange. It's utilizing the opportunity zone to defer current capital gains and eliminate future capital gains from investment dollars that you've made in other things outside of real estate. And Jason, any other additional comments there?
No, I think you hit the nail on the head. I think the one thing I would say is, at the end of the day, tax rates generally don't go down. So while you're saying, yes, you have to pay taxes now, you really don't pay them now. You pay them in 5 years with inflation and everything else, but your taxes are fixed essentially at the amount that you owe. If taxes continue to increase over time, and they do eliminate 1031, or they do get rid of, as Justin said, step up in basis, you could be staring at, 50% taxes versus, a third tax. There have been some fairly interesting tax proposals put out there over the last 15 months. I'll just call them interesting, where, taxes could go up substantially on gains such as in real estate and, unrealized appreciation. So
we're going to move on to another component of the opportunity zone that's got to be met. So as we've said, the original use of the property has to come into your ownership, and you have to make significant improvement. The next component that has to be met in an opportunity zone investment is active management. You want to go to the next slide? Thanks. And so, Jason, why don't you tell a couple stories? Why don't you first describe what that means, active management, and the requirement for opportunity zones, and then maybe tell a couple stories of what people are doing to satisfy the active management requirement to get the benefits of an opportunity zone investment. And some are doing it, I'm going to say, very, 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 very passively.
Very, very passively, yes. So the whole point of the opportunity zones was to create jobs and create continual jobs, right? It wasn't just to create construction jobs and then have the jobs disappear. It was to create actual jobs at the properties. And so the opportunity zones actually forbid triple net leases. It specifically says in the code, no triple net leases are allowed. Well, there's nothing outlawing a double net lease or a modified double net lease, right? It just says no triple net leases. And so the reason being is you needed to have some form of management to create a job. And essentially what we have started doing is finding these really great tenanted, new construction, pre-C of O, what you would traditionally maybe think of as a triple net lease transaction. And we renegotiate the lease. We renegotiate the lease to some form of a double net, a modified double net, where, we're taking on some ownership and responsibility. We're going to take on roof repair and maintenance. Well, when the roof has a 20-year warranty, that means that there's not a ton of roof repair and maintenance, but we're also sometimes able to use this to either win deals that are really competitive, right? Because we take a little bit off the plate of the tenant, and we're paying the same price as the competitive person who wants the full amount of work. Or we're sometimes even able to leverage it into getting a little bit better of a deal, right? If we're going to take on a little bit more work, and we're happy to do that for a little bit better of a return. And what Justin and I have talked about before is, sometimes we're happy paying the price, but we get the rent to go up. Well, why is that beneficial? Because when the rent amount goes up and then there's rental increases, you're actually increasing off of a larger amount, right? So we'll pay the same price, but maybe get a little higher rent, or you reduce the price some because we're taking on more responsibility. It allows you to maybe reach a property that you wouldn't have been able to and still get, a great return. So these modified double nets are something that we have a handful of clients that are thrilled with. They could not be happier. It is very minimal management. And we even have one that's doing a slight amount of management on his own and charging a 15% fee to the tenant for the actual work he has to do, which is taking an invoice, putting it into a new invoice and sending it to the tenant. So he's turned it into an opportunity to make a few extra dollars through his own active management.
It's the actual work that they would have paid for on their own that now they're paying him to do for 15% of the cost. We've got a lot of creative things that we can do to help people get in a really good position. For those of you that are online right now, we've asked 2 poll questions. You click on the little graph there or the questions here in the chat, and if you'd answer those, that'd be great. It helps us kind of continually revise what we're talking about on these things and what would be most beneficial to our clients. So if you get a chance, check out the polls and get your participation. Now we're going to talk about just a summary. So what are we going to do the rest of the way? We're going to talk a little bit about the benefits of an opportunity zone investment for an investor, which we've talked about over the first 30 minutes, but we'll give you a short summary. Then we're going to walk you through some of the numbers and some of the examples, because if you might have heard a second ago, Jason said, well, sometimes our clients pay for something that, people outside the opportunity zone aren't, and it might make it sound like you're getting a bad deal or not, it's not in your financial best interest. We're going to walk you through a couple of examples of what it looks like to invest in an opportunity zone, or using your capital gains to invest in an opportunity zone versus using fresh cash to buy a comparable property. Then we'll walk you through 4 examples that we've recently done. We're going to do 2 very passive net lease properties. We're going to show you a multifamily acquisition. Paul, maybe that's what we'll be doing with you, is watching you build a multifamily property and then taking it to market right before certificate of occupancy, and helping you get a price premium on the asset. And then we're going to walk you through a business that we worked with where it was just time for the owner. Didn't have any more heirs that wanted to be involved, was either going to shut it down in 5 years and get nothing for it, or they used the opportunity zone and the capital gains from selling their business to acquire some real estate that they're going to be able to leave their heirs. We'll walk you through those examples, and then we'll finish it up with any additional questions that you might have. So when we talk about it, or when we summarize it, what are the benefits of the opportunity zone? You defer the capital gains until December 31st, 2026. You don't have to pay them until as early as April of 27. And you can use that money to ultimately pay your taxes. As Jason mentioned, inflation at 8%, you're basically going to pay 50 cents on the dollar, thanks to the U.S. government giving you the ability to invest in opportunity zones. There is no capital gains tax on the gains made in the opportunity zone. So you invest your $1 million of capital gain into an opportunity zone, and in 2035, we sell that property for $4 million. The $3 million of gain and the $500,000, let's say, that you depreciated, all tax-free. A significant improvement. You don't have to die to avoid paying taxes. Another benefit of the opportunity zone is you don't have to buy one property and own that property till 2045 or 46. You got to hold opportunity zone property for 10 years, but you don't have to hold the same opportunity zone property for those entire 10 years. You can move your money around to different properties and to different opportunity zone businesses through your qualified opportunity fund. You get the ability to take distributions from the fund. So after about 2 years, if you wanted to refinance the property that you acquired and pull some cash out, the fund could make a distribution to you. Again, a tax-free event. There's avoidance of depreciation recapture. As Jason mentioned, effectively utilizing a little bit of debt in these opportunity zone acquisition gets you new depreciation. And there will be no depreciation recapture tax on the depreciation that you use. That's why you've heard him emphasize a number of times now using finding assets where you can use accelerated depreciation, or using cost segregation to front load the depreciation that you use. I just talked about cost segregation. And then, as Jason has mentioned, in some cases, it may be a better tool than a 1031 exchange. Those cases are very unique. What we do is we get our entire team involved and your accountant. We look at it from all the different angles to determine which one might be the better way to go about doing it. So let's shortly talk about the summary. Go to the next one, please. Before we get into the summary, Jason and I have talked a little bit about how this was the opportunity zone legislation was passed in 2017. Now there are some proposed updates to the qualified opportunity zone rules. The first one being census tracts. We mentioned earlier how it's done. The government looked at census tracts and identified the census tracts that they believed could have the best, would be the most beneficial to have significant investment. Now, this usually related to incomes of the population. And when they originally did the defining of census tracts, it was all published, and not every place at Beverly Hills doesn't have any opportunity zones. But what they did is that there are places that might not be Beverly Hills, but might be really good spots that happen to fall into opportunity zones. And that's where we've done a lot of targeting of the investment. So one of the things that some of our investors are trying to take advantage of right now is getting their money into the current opportunity zones that shouldn't be opportunity zones. Because if this legislation passes, they are going to redraw. Now, what that means is that if you bought a property in, for example, we're going to show you an example of a opportunity zone property in Virginia. That property was acquired in 2022. It's before the redraw of the census tract. So if they carve that property out of an opportunity zone in January of 2022, because the property was acquired prior to, it'll still have all the opportunity zone benefits. But basically, they're going to redraw some of these census tracts, and my opinion is that some of the best spots may end up getting pulled out, but there's still going to be a lot of good ones. Jason mentioned that prior to 2022, you got a 10% reduction in your capital gains tax that you paid in 2027 if you invested before 2021 and held for 5 years. Well, they're looking to extend that provision, and all dollars placed into an opportunity zone fund through December 31st, 2023 will have the 10% reduction if held through 2028. So we potentially see that coming back. And then some of the structure of the ability of opportunity zone funds to invest in other opportunity zone funds is now on the table to make it even easier for people to get more money into opportunity zone funds. Jason, you got any additional comments about the proposals to any of the changes?
No, I think you made a good point. Like there are a lot of ones that shouldn't be included. We've been targeting those, but there's a lot that will continue to be included that are great opportunities and growing and expanding markets. My favorite one to talk about is right next to Beverly Hills on Wilshire. It's like mid-city technically. There's an opportunity zone in LA. There's $20 million houses a 5-minute drive away, but it's not really an opportunity zone. But someone had worked really hard with their congressman to make it happen. So
those are some of the changes that were proposed and that we're seeing and that we're monitoring. We're going to summarize really kind of how you can go about doing this. Simply, you can invest in an opportunity zone fund, similarly as you could invest in a DST, where you have nothing to do. A sponsor runs the whole deal, and maybe you're building a 40-story hotel tower in San Pedro. Or you can create your own self-directed fund where you're the only investor in the fund, and you can go out and acquire opportunity zone property on your own that you control the timeline of disposition, of refinance, of all the different things. So either with a group or on your own, there's great options to get your money in play in an opportunity zone fund, which kind of will beg the question is, well, how much money do I need? It really kind of depends. To invest in a fund, they'll probably take 50,000 and lower as a small investor in an opportunity zone fund. To buy some of this stuff that we will ultimately show you later, you need a little bit bigger amount. But we can talk with you if it's something you really want to get, or you're interested in, and you want to have your own self-directed fund. We can take a look at how much you have in gain and make a recommendation on the best way to do it. What can you invest in opportunity zones? Again, the options are virtually endless. You can buy a business that creates jobs, and those jobs are conducted in an opportunity zone, or you can acquire property that its development will create jobs in the opportunity zone. And then what do you want from your investment? A management intensive investment, which might be you're going to buy a new construction apartment building and manage that property yourself and deal with 30 tenants and all the things that come along with it. Or do you want a stable, very limited active management sort of investment? And we'll show you a couple examples of those that have a very predictable cash flow and are as passive as you can be in real estate ownership. What you've got on the screen now is what it looks like when you compare investing in a qualified opportunity zone versus investing in a non-qualified opportunity zone. So we're going to talk about the proceeds from somebody's capital gain event to be $1 million. If you invest in a non-qualified opportunity zone, you're immediately going to pay 23.8% in capital gains, leaving your investment dollars to be $762,000. If you invest in the qualified opportunity zone, there's no initial capital gains payment. So you have the entire $1 million to work for you. You put that $1 million to work. In 2026, your capital gains come due. Had you got the 10% reduction for a pre-2022 investment, or if they change the provisions, which is likely, you pay only $214,000 in taxes in 2026. If you hold the property for 10 years, using the whole $1 million that you had, you'd have appreciation of about $2.5 million or $2.5 million. Using the $762,000 in a non-opportunity zone investment, that appreciation would get you to a little over $1.9 million. Now, if you sell at the 10-year mark in a non-qualified opportunity zone investment, you're going to pay capital gains again, this time $289,000. But in the opportunity zone, if you held for 10 years, there's no capital gain. So the net value of your $1 million of gain 10 years later in the opportunity zone is $2,379,000. In the non-opportunity zone, if you had $1 million in gain and you put it in a non-opportunity zone, the net value of your investment is $1,687,000. So there's a 41% benefit, or almost $700,000 benefit on a $1 million investment in an opportunity zone versus not investing in an opportunity zone. That's why we see so many people starting to utilize this as a tax strategy with a real estate benefit. So that just shows you the numbers, how big it can be, what that impact can be. Go to the next one. This next slide will show you if you had a $4 million investment, again, opportunity zone fund versus a non-opportunity zone fund, what that looks like over 10 years when you accumulate the cash flow and the appreciation from the asset, what a benefit this exact same property located in an opportunity zone looks like. And you can see in the background there, we've got a Starbucks as an example. We were recently working on a Starbucks in a college town in the Midwest that it was literally at Main and Main for a 20-mile radius. And there's one of the fastest growing small colleges in the state, less than a half mile away from this Starbucks, selling and trading at the exact same cap rate, a Starbucks was selling for 30 miles away in a very similar town. So a lot of benefit from this opportunity zone options. Why don't we answer Mehdi's question, then we'll get into more of the numbers. The question here, Jason, we own an apartment building bought 4 years ago in an opportunity zone. We're going to tear it down and build 63 units. Does this qualify?
Unfortunately, you won't necessarily get the benefit. You could sell it to your own opportunity fund, but there's a related party rule, so you can't own more than 20% of the buying entity, which might work if you're doing a GP LP syndication, but generally the answer is no. However, as Justin had indicated earlier in our discussion to Paul, there might be a time when you're getting close to completion that Justin and his team can use strategies based on it being in an opportunity zone to get you a premium price on the property. And I think there's actually a property we're going to talk about here in a minute as an example that was in a very similar situation to what you're describing. And I'm fairly confident it got a premium price from an opportunity zone buyer.
Mehdi, I think there's a benefit to you. Maybe not in the quote unquote traditional opportunity zone way because of the 4-year time frame that now you've held this property before you've got the 63 units on it. But there's let's call it a non-traditional way where we can get you the benefits of the intelligent buy that you made 4 years ago and get you compensated for not only making that buy, but getting the property in a position where you could put 63 units on it and really improve the neighborhood. You want to go to the next one. We're going to show you this here. And really what I want to show you, or the point that I want to make, is that when you look at property outside an opportunity zone versus buildings located in an opportunity zone, for an investor to buy a property, if you bought a 4.25 cap outside an opportunity zone, the typical, let's call it Starbucks with a 10-year lease and some extensions outside an opportunity zone, trading at a 4.25 cap rate, which is what we typically see right now for buildings outside of California. That same building that you pay a 4.25 cap for in an opportunity zone, to get the same returns as the opportunity zone property, you would need to buy a 5 cap Starbucks with the exact same lease term to get the same financial benefits as the opportunity zone property. So there's a significant financial benefit to buying these opportunity zone properties and getting not only the depreciation recapture avoidance, but also paying no capital gains tax when you would go sell the building. We're going to get you into a couple of examples now. The first one, this is an apartment project in Anaheim that was offered at $9.3 million. Jason, you've got a little bit of insight into this deal. Maybe talk about what you know about the transaction and how it worked out for not only the buyer and their opportunity zone benefits, because they're going to get a brand new construction multifamily property in Southern California and be able to avoid a bunch of capital gains, but also the premium that the owner was able to get by developing this asset to a pre-certificate of occupancy level.
So this deal is really fascinating. I think we had a couple of clients we tried to have bid on it. I had a couple clients that bid on it. I had a couple clients that lost. I had a client that won. And it was an interesting situation because not often have we seen an apartment building, and especially an apartment building of this scale and magnitude, hit the market that was in the opportunity zone pre-C of O, which is why, Mehdi, I think you have like a great opportunity in front of you. I think this ended up trading roughly 40 basis points below or like better than what market was. So if market's a 5, it traded at a 4.6 cap, right? They got a premium from the buyer because the buyer looked at it and realized, look, I'm getting a brand new building. I can tenant it. It's not subject to AB 1482. It's not subject to any rent control. I can raise rents. It's new property, so I don't have a lot of headache to deal with on the maintenance and operations side. And it was in a really good location. And it had, I would say, you generally speaking are getting a little bit more upside in rent growth historically, or a lot more potentially on apartment buildings than you are on a net lease transaction. It did have management. It does have more management work, but the client had, a third party management company that they liked working with. And the buyer ended up being thrilled with the opportunity because they essentially didn't have to do any of the work and got a brand new building that fit exactly what they were looking for. So the seller got a premium. The buyer was willing to pay the premium because it got all the depreciation benefits, the rent growth, everything else, all tax free, and everybody walked away extremely happy.
It turned out being a win-win opportunity, I think, kind of for everybody involved. The seller of the asset, I think, in our opinion, didn't appreciate or undervalued what they were bringing to market. They were looking at the selling a uncertificate of occupancy vacant building as potentially negatives in the marketplace. And to Jason and I, it was a huge opportunity and a benefit to opportunity zone investors. Ultimately, the clients that we talked to were aggressive and were willing to go above what was the list price on the asset because there was a financial benefit to them. And even though they might have been paying a little bit above list, the financial benefits to them were so good that it was way worth it. As Jason says, Mehdi, when we talk about where we think you have an opportunity in this situation, or Paul does, we think we can help you monetize what you've got. We also think that to an opportunity zone investor, there's tremendous benefits to maybe beat out all the competition and pay a premium because they are still going to get significant financial benefits.
Justin, remember too, right? If you're a normal traditional buyer, every dollar more you go is a dollar more that hurts you and costs you eventually, right? In our situation, every dollar he went above there was potentially 40 or 50 cents of depreciation that the buyer got to realize over the hold period. And so it wasn't as bad because it just created an additional tax benefit to them to pay that premium, right? So it hurts a lot less to pay more because you're just actually creating more depreciation as well.
The next one we're going to show you is, we'll call this an example of a roof and structure opportunity zone transaction. So in this case, our client acquired this Chipotle in Roanoke, Virginia, a brand new construction asset where they are responsible for roof and structure and the common area maintenance. Jason, you want to talk about this deal, why it is such a good one for our client, and what the benefits were of getting into this one?
So I like the transactions when we're doing these passive deals where we get a great corporate tenant with a big guarantee essentially behind it. This one is Chipotle. It's a publicly traded company. It's a corporate store. I'm not even sure if they have any franchises, but they corporate guaranteed the lease, brand new lease. We bought it right from the developer. We closed 3 weeks before C of O. We started collecting rent within 6 weeks. And I love this, and I talk about this deal because the average household income within like 3 miles of this property is north of $100,000. If you notice today in the items that they're talking about eliminating the opportunity zones in areas that where there's 135% income, the thresholds, this would probably be eliminated from the opportunity zones going forward. But you have a great tenant with a great brand in a great location, and the client only has to do roof maintenance and a little bit of management, but he's charging the 15% management fee to the tenant for the small amount of work he has to do with his time. So he's benefiting as well.
I think another benefit that we were able to get in this transaction is, this site was the prototype store that they will now start developing. And so because of that, the developer did a bunch of extra things in this store that is going to be valuable for our client down the road as well. So in addition to the great tenant, you get a great building that's got warranties for roof and structure. And you have the great demographics, and they deferred their tax, and they're going to avoid the tax on their gain over time. And, this sort of location, I grew up down in Orange County, and there was a Carl's Jr. and a Del Taco that were there basically when we moved in. And whatever somebody paid for that site 40 years ago or 10 or 15 or 20 years ago, the rent now, because of the density around the property, is significantly more, and the value of that asset is so much more that even on these long-term lease deals where the leases are relatively fixed, time in these areas that are in the eye of development or in the path of growth are going to be worth significantly more down the road.
Justin,
next one will show you.
Justin, on that deal, I think our client's biggest regret was not buying the Smoothie King property next door. He says too. He loves the deal that much.
The next one we're going to talk about is this Burger King acquisition in Vincennes, Indiana. That is a great use, an interesting use of timing, an interesting use of how an opportunity zone investor can take advantage of sometimes a real estate investor's need to get things done at certain times of the year. This property sold at a 5.5 cap rate with a publicly traded tenant with a brand new lease and brand new construction. In this case, this is an example of a property tax management exchange, and I'll let Jason talk about that because his wisdom on how to structure this in a way is really going to benefit the client over the long term. And we took a property that was offered at a triple net lease, made it into an actively managed double net lease that's going to meet all the opportunity zone criteria, and got our client a great return.
So this one was really interesting. I think someone on Justin's team described it as the biggest Burger King they've ever seen. But it is on the corner of Main and Main in Indiana, across the street from a university that anchors the area. Fortunately, the builder, developer, and tenant needed to close the property before the end of the year. We actually went into contract and closed the property in 9 days because everybody needed to get out. It was close to the end of the year last year. We were able to essentially take the property tax portion out of a pure triple net lease, and we created a section on the lease that's additional rent. Now, the additional rent isn't tied to the property taxes because the additional rent gets reassessed every 5 years. Property taxes in that state get reassessed every 4 years. And so the additional rent has some initial affiliation to how the property taxes will work, but the client is still responsible for managing that property tax bill. They have to get it in, they have to send it to the tenant has to make sure that it gets paid. So there is some active management involved. And I do remember, I think as well, when the client went to visit the property, they were at their hotel, and the receptionist at the hotel said that Burger King was their favorite restaurant, and it made the client very happy to know that he owned the Burger King down the street. So.
Yeah, this one to me is really kind of the win-win opportunity of opportunity zone investing, and let's call it real estate investing. The developer / tenant had an end of the year need to sell this before they could finish the development of the property. And because they had a capital need, and let's call it for their books to get some certain things done, it allowed the opportunity zone investor to acquire it before it was done and get a premium return because it married so perfectly what we need to do in opportunity zone deals and what the real estate investor needed to do. So when we talk about these things really being win-win for everybody involved, this was a great example of it, and how we restructured the lease to fit the opportunity zone guidelines worked for everybody involved. The next one we're going to show you is Pacific Neon. This was a business sale. Third generation family business, 74-year-old president with no heirs who wanted to be in the business. Ultimately had a capital gain of $14.2 million and decided to sell the business now versus keeping it a little bit longer, making some cash flow, and ultimately shutting it down, and reinvest that money into an opportunity zone. They saved $337,000 by getting the opportunity zone set up and funded prior to December 31st, that they're going to pay $337,000 less in taxes in 2027. And they will have over $1 million benefit for their heirs if they own the Opportunity Zone properties for 10 years. So it's not just, a real estate play. In this case, it was somebody who just purely had a business that they'd made a bunch of profit on, or could take those profits and realize them to get their family into a piece of real estate versus just having the business. So there's a lot of ways that investors can do it and accomplish taking advantage of the Opportunity Zone investment. And it's just another way of doing it. The last thing that we're going to walk you through is that we're a little over an hour now, is kind of a very simple six-step process of taking capital gains and getting it into very passive opportunity zones. The first one is you have the capital gain event, and within the timeframes that Jason talked about earlier, you create a qualified opportunity zone fund that you are self-directing. Number two, we find an opportunity zone property for sale that meets the criteria. One that you're going to acquire, one that you're going to be able to benefit from the significant improvement, and one that you're going to actively manage. Step three, we just talked about it. We buy it pre-certificate of occupancy, because pre-certificate of occupancy gives you the benefit of the property being placed in service during your ownership. It being placed in service during your ownership allows you to take the credit for the significant improvement. Step four, on these properties, what we encourage you doing, because a lot of times a conventional lender won't offer the most aggressive terms, is that if possible, you self-finance a portion of the acquisition. So you basically, as an individual, loan your opportunity fund some of the acquisition capital. We create the compliant management structure. Jason does a great job of figuring out what works for the tenant and what works for the owner to provide the owner with an active management strategy. Once we have certificate of occupancy, step 6 is go to a conventional lender. For example, on the Burger King property and the Chipotle, I believe our client was crowing about getting interest rates of 3.1 and 3.25. Once they had certificate of occupancy with these corporate tenants, they refinanced out their self-funded portion that allows our client to get the benefits of depreciation. Now we're going to be setting up a cost segregation study so they can accelerate that depreciation. And that is basically the 6 simple steps that somebody who may not be an active real estate investor can get into enjoying a very passive, easy to manage cash flow producing asset that benefits from the opportunity zones. Jason, any comments as we close this out?
No, I just think that this is a great opportunity that people need to take more advantage of. And I appreciate the opportunity for you guys having me today. And hopefully we'll be able to help some more folks. I will say that 3.75 interest rate closed 4 days ago. And if you pay attention to what's going on with rates in the market, 3.75 rate's a pretty solid loan right now.
And it's to the quality of the location and the quality of the tenants and the fact that it's brand new construction with long-term leases that gets the client the, let's call it, best available debt rate out there. What we'll do is we'll open it up to questions. We'll stay on for maybe a minute if any questions roll in. Now would be a great time to use the chat to ask us your question. If you haven't participated in the poll yet, please do so. As I said, it gives us the opportunity to kind of tailor some of the content that we produce to match up with what interests you most. But if you've got a question, now may be the time to ask it. If you got a long question to ask, use that chat to just tell us we got a question coming, and we will answer as many of these as we've got here in the last couple of minutes of today's webinar.
The one thing I will add too is, maybe there's questions popping up today. Reach out to your advisor. Reach out to your advisor at Centennial. Reach out to someone on the team. They'll help guide you through, how to analyze your portfolio and look at if this is the best strategy and how we're going to make it work for you. Paul, I think we can reach out to you directly after and give the contact information for both Justin and myself.
And there we've got it for you if you want to email us that way. And, the one thing I think I would add about this is, we're certainly very passionate about the opportunities and opportunity zones. And one of the poll questions, a lot of the answers was, didn't know about it. This might be the first time you're hearing about it. We get that a lot of this process is answering questions, and answering those questions sometimes is going to lead to people doing transactions, and other times it's going to lead to them and us determining that it's not the perfect thing to do right now. And I would encourage you, regardless of whichever one of those boats that you end up in, we want to help you understand it better. We want to help you figure out if now is the right time. And if it is, great. And if it's not, that's cool too. We certainly understand that that's part of the process. And if we can help somebody learn more about it, we really want to do it. Jason, we've added Jason's email address there on the bottom. You know, Paul, Mehdi, anybody else who's got questions, we'd love to help you. And if it's opportunity zones, great. If it's you've got a piece of real estate and you want to know what you should be doing about it or with it right now, or you want to figure out, I've owned this thing for 20 years or 30 years. Am I making as much money as I could? We got a lot of great people at Centennial that can help you look at your asset today, see how it's performing, and compare it to some options out there that might help you do better and more meet your goals today if they've changed over time. Thanks for joining us today on this webinar. As we've talked about opportunity zones, it's always our pleasure to share as much information with you as we can, and we look forward to being assistance.